Welcome to Brookfield Perspectives. On today's episode, Hadley Peer Marshall and Craig Noble join us to talk about the growth in private credit over the last few years, where the opportunities for expansion lie, and how the firm is navigating more volatile market conditions. Hadley, Craig, it's great to have you here today. Thanks for joining us. Why don't you introduce yourself and tell us a little bit about what you do at Brookfield?
I'm Hadley Peer Marshall. I'm the CFO of Brookfield Asset Management and also the co-head of our infrastructure debt and structured solutions business. I oversee the origination execution of the investments we make in these strategies.
I'm Craig Noble. I'm the CEO of our credit business. With that, I oversee our Brookfield credit strategies, as well as several partnerships we have with other credit managers that we work closely with.
So, Craig, it's definitely been a very eventful 18 months for credit at Brookfield. Can you just give us an overview of where the business stands today?
Our credit business, on the one hand, we've been at it for 30 years. But on the other hand, it feels like we're just getting started. We've pulled together everything we do in credit under one broad umbrella, which we did about 18 months ago to form the credit group, really with the vision that private credit continues to be a very strong growth area. By having everything more closely coordinated, we can really bring some of these interesting private credit solutions to our clients in what is a very rapidly growing and evolving market. It's been busy. We are growing the business significantly. We have over 300 billion of assets under management today, and the growth continues, which is wonderful.
It's interesting because our business is a little bit different than what you see from other credit managers, our peers, because we focus heavily on real assets. Real estate, infrastructure, asset-backed finance, and opportunistic, of course, with our partnership with Oaktree. So that is a little bit different than what you see out there in the broader universe.
It's exactly right. Many people think of private credit as being direct lending, which is one part of the market, but really the opportunity as we've attacked it has been really coming at real estate credit from a real estate perspective and infrastructure debt, Hadley, as you know, from an infrastructure perspective, which has been an amazing foundation. We've broadened that over the years, building many of those capabilities organically. In other cases, bringing on other managers into the Brookfield family. Our approach is focusing on the areas where we've got really strong operational capabilities, part of our global footprint, which has been wonderful as we originate transactions, structure them, underwrite deals, and manage the assets over time. So, Hadley, you're spot on that has been really our philosophy across everything in Brookfield, and it applies very strongly to the credit space as well.
Yeah, there is no question that there has been an explosion in the private credit asset class, especially in the last few years. So where are we seeing some of the greatest investment opportunities, and how exactly are we approaching them?
It's interesting because one of the competitive advantages that we have at Brookfield is the certainty of capital and the quick execution and scalability. And then we overlay that with bringing flexible capital structures to bear. That allows us to really be a partner of choice. And it translates into a lot of opportunities that actually grow over time. In our infrastructure business, specifically, one of the big benefits is the asset class is growing significantly. And that's part of the thesis that Craig was discussing a second ago about the growth that we see attached to our credit business. When we're looking at opportunities, one of the reasons that we are a compelling partner from the borrower's perspective is we can scale. And when you're in an asset class that can grow quickly, that's very valuable. Many of our deals will invest 200, 300 million, and then there will be opportunities to upsize over time. The other interesting aspect to our business is because we're an owner and operator of these assets and have a huge equity franchise that we've built for over 100 years, that gives us a lot of learning lessons and technical expertise that we can apply to our investments and can really dig into the underlying credit profile, which does mean that we understand risk better than others. And we're not just a financial player from that perspective. That comes to giving some execution stamp around the deals we do. As an example, we've been very active supporting a company called Posigen. They're a residential solar company. They started out back in 2011 on the backs of Katrina in New Orleans and building energy security. And they've grown since then. And we've continued to support them in upsizing our investment and thought through how to be a flexible lender, but more importantly, scaling over time in order to provide that certainty of capital for them.
Those themes that Hadley's describing in infrastructure really apply to everything that we're doing. As we think about the benefits of large-scale capital flexible capital and a global footprint where we can move our capital around the world, not just to different geographies, but also different sectors where capital is scarce or where we can bring our expertise. In the real estate space, very often that's working directly with borrowers. In some cases, it's because banks are retreating or have retreated, as they have particularly in asset-based financing. But in other cases, actually, banks continue to lend and have relationships with the borrowers, but we can come in and partner with banks and allow them to have their balance sheets be much more capital efficient. And we can bring our underwriting, whether it's in corporate lending or infrastructure or real estate. That trend of banks retreating, we've observed. In some areas, it's in the context like infrastructure, where there's a tremendous amount of capital that continues to be required for the build-outs. In other areas, it's like asset-based financing, where it's just less suitable for bank balance sheets.
Let's talk about something that's on everyone's minds right now, which is uncertainty, volatility in the market. How is this current environment playing out, and how does that affect our investment outlook here?
I think we're all surprised that the markets have tested asset classes as much as it's happened over the 10 years. But I think it's been a good thing that we've seen high inflation rate, low interest rates, high interest rates, COVID, now the uncertainty and the volatility we're seeing in the current market. Because when you think about, especially in our core competency of real assets, these are areas that you now have the track record and you can show how did they perform. What really does happen in a high inflation environment to infrastructure and real estate? Are they really correlated? Data is now available. And I think it just strengthens the case on the fundraising side for investors to have more conviction that it can deliver what they're hoping it can deliver.
Hadley, I agree with that point. We have an approach to lending across all of our credit businesses where we're really protecting on the downside. We're structuring our deals that way, which can be challenging, even frustrating, when it is an overly frothy market. Infrastructure has been, well, all asset classes have been tested, but I'd say infrastructure really stood the test of time in terms of resilient cash flows, no matter what was thrown at it through COVID and inflation and rates. But I would say the environment that can be a little bit more discerning for investors suits us pretty well.
I would say that the uncertainty we're seeing in the market is really the upside to our business. Craig was alluding to the pullback from the banks. Real estate's also having opportunity sets driven by bad capital structures with good assets. When you think about the uncertainty in the existing environment, that just makes our capital more valuable. The same with Oaktree and their opportunistic fund or Castlake and their ABF strategies. It's an interesting time because there's always seems to be some disruption. Craig, a few years ago, you're dealing with the regional banks and the pullback there that impacted real estate and infrastructure, the leveraged finance market closing or opening, banks retrenchment. There's all these themes. And now today, just the uncertainty and the volatility that exists in the market that may most likely continue to play out. That just makes, again, our capital more valuable, and that certainty and the scalability, something that really is honed in on by the borrowers.
As things continue to go up and down, and there's some volatility here and there, large institutions sometimes want to consolidate a little bit. They want to have a bit more certainty, a bit more assuredness with who they're working with. And that's a dynamic you were mentioning, Craig, around being one provider that can really offer a whole range of solutions or products as opposed to just one.
Yeah, that's a trend we've been seeing across the asset management space. Large institutions want their capital to be strategic, meaning they want to do more business with fewer managers. That really plays, again, to our strength, given our scale and the size and nature of the relationships we have with pension plans and endowments and sovereign wealth funds and large pools of capital around the world. In fact, that's translated into our strongest fundraising over the last several years, including in credit. As we're seeing the credit market and specifically private credit growing, we find these investors who want to have very large and strategic relationships, and that's a big engine for our growth.
On the infrastructure side, it's interesting because back 10 years ago, Craig, you'll remember this, and it was a new asset class to a lot of investors. And we copied everything that we had done on the real estate side because we had been active for over 20 years. And so we had a playbook when we started up the infrastructure credit business. But that newness meant that investors were really attracted to the diversification since they really couldn't find it in any other place. And then you add that with the growing aspects of the asset class, that digitalization, the decarbonization, the deglobalization, our 3Ds that we always talk about. Those are major themes that are continuing to push. But I also think it's interesting, Craig, on the ABF side, because that's an area that's really untouched from a market perspective. I mean, I think about 10% is really allocated to private credit at this stage. So there's huge growth opportunities there as well.
Yeah, asset-based lending is one of the more interesting areas, and it's for a few reasons. One is, as I said before, banks are pulling back. These are difficult assets to own on a bank balance sheet. Secondly, it really requires a highly specialized skill set in order to invest in airplanes or machinery or residential non-conforming mortgages, as Angel Oak does. So it's got this combination of highly specialized skills to originate these differentiated types of loans, getting as close to the actual borrower as possible, as opposed to buying loans off of a screen. But secondly, it's scalable. Many of these areas, the amount of capital that is required to finance these types of activities is tremendous, trillions of dollars. And the investment thesis relies upon the borrower continuing to make their payments, but we've also got this fallback in asset basis that there's a contractual cash flow stream, very often a hard asset that is underpinning it. And Hadley, a lot of those things are similar for infrastructure, including the amount of capital that's needed in infrastructure. You're right, 10 years ago, we weren't sure how the space would evolve, but today, the 3Ds, just the amount of capital that's required for any one of those is tremendous.
And the other common theme, and Howard Marks would be very proud of us, is that we live and we structure our deals covey heavy, not covey light. And that's a broad theme for any of the businesses that we invest in.
On the real estate side, we did a deal several months ago that's interesting because it captures two themes. One is partnering with banks, but secondly is this asset-backed type of lending. And it was a U.S. regional bank who was looking to lighten up their balance sheet, realize value on their portfolio, where it's difficult otherwise for investors to understand what the true value is. And we worked with the bank, underwrote a portfolio of roughly $1 billion across 40 some odd commercial mortgages. And it was excellent because we were able to underwrite every single mortgage, as opposed to a large pool that is difficult to actually do the underwriting on each. And that's our approach. Large scale, able to move quickly, be flexible, something that is in our sweet spot that we're able to do a significant amount of underwriting. And there's much more to come in these types of deals, not just in real estate, where there's some amazing assets that require more capital, but really across all of these different sectors. One of the areas that will be growing more is the investment grade private side of things. Usually private credit on the corporate side is sub-investment grade. Increasingly, corporate borrowers are looking for, I'd say investment grade issuers on the corporate side are looking for debt and more with a private structure, but they have an investment grade rating. So that is a newer part of the market, but it's poised for some significant growth.
I'm hearing both of you say that while there's a lot that's already been going on and a lot of growth that we've seen, there's still a lot more ahead for this asset class and for private credit broadly. Where do we see things going in the next few years at the very least?
Asset-based lending is a really broad market, and there continues to be some really interesting growth opportunities. We have a very large asset-based lending platform today across Brookfield, as well as our partner managers, Castlelake on the aviation and the non-aviation side of things, Oaktree, LCM on the consumer side, and Primary Wave, which is a royalty business, which we think is going to have some significant growth just given the return profile. And one of the next additions to the Brookfield family would be a partnership we recently announced with Angel Oak, which is a non-conforming residential mortgage originator in the US. And so while that's the platform we have today, I think there are more opportunities to build out in that part of the market. There's a lot of demand from clients, from investors, and the banks are not growing with the market, not anymore. So that's where private credit's moving in.
It's a similar thing in the infrastructure space where the asset class is growing so quickly and the banks cannot grow at the same pace, which has been a valuable tool to introduce private credit. And we've been able to double our deployment. Our pipeline is very strong in terms of what we see going forward. And data centers, renewables have been a big active part of that pipeline. But we are starting to see these themes more broadly around deglobalization. And that will be impactful for logistics on the real estate side, but transportation, utilities, energy, renewable, especially when you think about the supply-demand imbalance that we now face in many jurisdictions that we invest in. That power need is going to be something that's really going to push the opportunity set. We have a large infrastructure renewables business, similar on the real estate side, where we can go out and talk to the various owners of infrastructure and renewable assets. And the conversation we have now is, how can we be helpful? How can we provide you capital? Equity is a very compelling source of capital, but at times that may not be the fit. They may not be looking to sell equity. It may not fit the types of returns and strategy that we have. And so we can pivot and then think about it from a debt lens. And can we be a relationship builder from that perspective? And so that's been incredibly helpful in building our pipeline. About a third of our deals actually come from our colleagues on the equity front. So it's powerful.
These are very large scale opportunities. Is the SMA business something that we're also thinking has as much potential?
We've been investing on behalf of insurance companies for a long time. So this concept of these broad, complex, separately managed accounts, we've really refined and perfected over the years with a handful of clients, one of which being the Brookfield Insurance Company, where we're managing capital on their behalf, investing in private credit, but doing it in a way where we're being very thoughtful about the insurance considerations, the structuring, the ratings considerations, some of which are very unique to insurance companies. What we're seeing from large institutional investors, I'll use insurance clients as an example. There's a movement of shifting a portfolio from publics towards privates. And we've seen this on the equity side for the last 20 years. And it's starting to gain more and more steam on the credit side. Think of a large insurance company who has liquid investment grade and sovereign corporates, and the insurance companies need to earn more on their portfolio. So they're shifting a portion of the portfolio into privates. The goal of private credit is to earn excess spread, higher returns for the same type of risk compared to the public market. Capital's being locked up, so it's an illiquid investment. So there should be more return that is offered. And that is the case. There's excess return in the private markets because of things like the complexity, the flexibility, the speed of movement that borrowers value, as well as it's less liquid. The way we work with insurance companies very often is in these large separately managed accounts, or think of it as a fund of one, where we can build a customized portfolio for them across all of the private credit areas that we are investing in, or whether that's infrastructure, credit, real estate, corporate credit, ABF, and we can customize it also to meet their credit rating needs, as well as some of the unique structuring needs that insurance companies have. So we'll call that the separately managed account part of the business, and it is a rapidly growing part of the business.
There's been a lot of dynamics that have led us to where we are currently with this. And as you both said, there's a lot of room to run here. But has there been anything that surprised you as you've expanded and diversified and built this capability more within the firm over the last few years?
There's always the unexpected. And some of the things that have just evolved a little bit differently compared to maybe what we would have envisioned a few years ago would have been just, I'd say, the variety. That many years ago, direct lending was somewhat synonymous with private credit. Direct lending to private equity sponsors in the US, sub-investment grade, that continues to be a large part of the market today. I've been continuously impressed by the desire for corporate borrowers to pay for deal certainty and speed. And maybe I'll add deal flexibility to that as well. Private credit, investors want to get excess returns compared to the public markets for the same type of risk, which means that the borrower is paying a higher coupon or a higher return. And that's because of the value that many borrowers, not all, but many borrowers, depending on their situation, place on having something other than a cookie cutter deal, something highly customized to meet their needs, or unique covenant package or repayment or collateral pool. And that's valuable, as well as deal certainty and being able to move quickly. So those are really fundamental elements of the private credit thesis. And I can think of several transactions that we're working on now, where really that's the secret ingredients.
The only other thing I would add is the question in this environment has been, how do we, with decarbonization, one of the major themes that's been playing out in our renewable business that's creating a lot of opportunities from a credit perspective is the fact that for the longest time, 20 plus years, the demand for power was pretty stagnant. And then you had the electrification occur and now the AI boom. And we have a significant imbalance that exist. And all technologies will come forward and try and solve that problem. Some are available now, some there's a long lead time. But that is creating a lot of opportunity set. And part of the reason that the infrastructure numbers over the next 2040 are so significant. And even if we're off by 10, 15, 20%, they're just so big and the imbalance is so big. And then if you add manufacturing, returning and onshoring, that deglobalization theme, it just continues to build out even further.
That was a really great conversation. Thank you both for joining us today.
Thank you.
Thank you.
This podcast is for educational and informational purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any securities or related financial instruments offered or sponsored by Brookfield. The information and views discussed are subject to change without notice. Any investment involves significant risks, including loss of the entire investment.
Audiation.